Hello, this is Carole Foos with OJM Group. I'd like to thank you for listening to our podcast. Today's podcast is called The New Tax Regime. Was April 15th, 2013 unlucky for you? I'm sure many of you recently filed your 2012 tax returns. For some of you, that may not have been a pleasant experience. And unfortunately, for a lot of our clients and our listeners, 2013 may be much worse. I'm Carole Foos. I'm the Director of Tax Planning at OJM Group. And we do want to show you a couple of disclaimers. We are a registered investment advisory firm. Certainly none of the information contained in this podcast should be considered to be personalized investment advice. Always consult your investment advisor before you do anything investment related. In addition, it's general tax information that we're going to be discussing today. For any personalized tax advice, you should consult your own tax advisor. We would like to offer you, as thanks for listening to us today, the opportunity to get some of our materials that have been published by the partners of OJM Group. You can see on your screen some of the books we have published. Many of them are for doctors. We also have Wealth Secrets of the Affluent, which is written for high-income individuals, and some CME pieces for doctors as well. And we're going to tell you at the end of the podcast how you can obtain those materials for free. Today's topics that we will discuss include the new top tax bracket under the Taxpayer Relief Act of 2012. Is that going to apply to you? We will also talk about the Surtax under the Affordable Care Act, commonly known as Obamacare. What's going to happen to your investment income with that surtax? Itemized deductions and exemptions. You used to get a little more bang for your buck out of those deductions on your tax returns than perhaps what you'll see moving forward. And lastly, we'll talk about where you might go from here. What can help you take away some of the sting of the new tax rate increases, including tax management of your investments, Roth accounts, installment sales, and tax-exempt income. So we will start today discussing the new top marginal tax bracket. As I'm sure many of you have read and are aware of, the American Taxpayer Relief Act of 2012 was signed into law by President Obama at the beginning of January 2013, effectively avoiding the fiscal cliff. And that act added a new top marginal tax bracket of 39.6%. Previously, on the 2012 tax returns that you just filed, the top marginal bracket for individuals was 35%. This new 39.6% bracket applies to taxable income over $400,000 if you're a single taxpayer, and over $450,000 if you're a married taxpayer filing jointly. And this new rate is effective as of January 1st, 2013. So what do we say? In this Tax Act and in the Obamacare Act, there are a lot of different thresholds and a lot of different incomes being discussed. This bracket applies to taxable income. What is that? Well, to come up with your taxable income, you'll look at your total income, which includes all sources of taxable revenue, meaning compensation such as wages, your investment income, interest and dividends, any capital gains that you may be taxed on, flow-through business income, which would be income you receive from any partnerships or S corporations that you invest in, retirement distributions, and any other miscellaneous income, including Social Security benefits, that you might have included on your tax return. From that total income number, you will deduct any adjustments to income. Those include contributions to your health savings account, any self-employed health insurance deduction that you're entitled to, contributions to your SEP or your KEO plan if you contribute to those types of qualified plans, as well as half of your self-employment tax. After deducting those items, you're also able to deduct either the standard deduction or your itemized deductions. Probably most of you take an itemized deduction, and those itemized deductions include state and local income taxes, real estate taxes, mortgage interest, investment interest, charitable contributions, and other miscellaneous itemized deductions, as well as medical expenses if they exceed the threshold. And finally, you'll deduct personal exemptions in coming up with your taxable income. Personal exemptions for 2013 are $3,900 for each person claimed as an exemption on your income tax return. So this new bracket is an increase of 4.6 percentage points over the previous highest individual tax rate. We went from 35% to 39.6%. But what you need to think about is that effectively translates into a 13.14% increase in the amount you're paying. So you're really going to pay 13% more taxes in 2013 versus 2012 within that top tax bracket. It essentially eliminates the 35% bracket for single taxpayers. That bracket still exists, but it only applies to taxable income from $398,351 up to $400,000. And then you move right into the 39.6% bracket. Reduced deductions and exemptions, which also go into effect and which we will discuss later in the podcast, mean that even if you weren't at $450,000 of taxable income in 2012 and your income stays exactly the same, you could still be at $450,000 of taxable income in 2013 because you're likely to lose some of your itemized deductions and your exemptions. Taxpayers in this new top tax bracket will also see an increased tax rate on long-term capital gains and on qualified dividends. These rates increase in 2013 from previously being at 15% now up to 20%. Again, that translates into an effective increase of your long-term capital gains tax of 33 1/3%. So think about that. Selling a stock this year versus in 2012 could cost you 1/3 more tax because of the capital gain. So in addition to the news from the Taxpayer Relief Act, we also have the Obamacare taxes going into effect in 2013. The Obamacare tax includes a new surtax on net investment income, which will be 3.8% on the lesser of net investment income or the excess of modified adjusted gross income over certain thresholds. And those thresholds are $200,000 for single taxpayers or $250,000 for married taxpayers. So if you have adjusted gross income, which as we talked about a few minutes ago, that would be your total income that you take in, less the adjustments including HSA contributions, SEP or KEO contributions, self-employed health insurance, and half of your self-employment tax. If you get to that number and it's over $250,000 if you're married, you will be subject to this surtax. The surtax also includes a 0.9% increase in the hospital insurance tax on wages. So, what we commonly refer to as the Medicare tax on your wages, the employee portion of that will go from previously 1.45% up to 2.35%. Again, this applies only to the employee portion, and it only applies to wages over those thresholds of $200,000 or $250,000. This makes the total combined employee and employer Medicare tax 3.8%. One thing you're going to have to be aware of is if you're subject to this tax, for instance, you may have income of $300,000, wage income of $300,000, and you may have a spouse with wage income of $100,000. Well, your employer will withhold that extra 0.9% on your wages above $250,000, so the $50,000 that will be subject. However, your spouse's employer, because your spouse's wages are only $100,000 and therefore by themselves not subject to the surtax, will not withhold those taxes. So again, the surtax you need to be aware of with your withholding amounts as well as with your estimated payment amounts if you're making estimated tax payments on your income this year. So what is net investment income that this surtax will apply to? It's going to apply to your interest income, your dividend income, both qualified and non-qualified, rental income, royalties, capital gains, and income from passive activities. So activities where you are not a material participant, including passive partnership and S corporation income, will be subject to the 3.8% tax. What about the itemized deductions and exemption limitations? Well, again, not only do we have increased taxes and a new surtax, but we're also going to see fewer benefits from itemized deductions and personal exemptions. Itemized deductions will be limited, called the PEAS limitation, and there's a phase-out of personal exemptions, commonly referred to maybe in articles you're reading as the PEP limitation. These limitations, we have another new threshold, apply to taxpayers with AGI over $250,000 if you're single and over $300,000 if you're married. So let's take a step back. If your income is $450,000 and you're a married taxpayer, you've got the Affordable Care Act surtax, which applies because your AGI is over $250,000. You've got limitations on your itemized deductions and exemptions, which apply because your adjusted gross income is over $300,000. And you've got a new tax bracket that applies because your taxable income is over the threshold amount of $450,000. So the itemized deduction limitation will cause your itemized deductions to be reduced by 3% of the amount that your income exceeds that threshold. So if you're married, the threshold of $300,000, but up to a maximum of 80% of your itemized deductions could be phased out. So you will always get to deduct at least 20% of your itemized deductions. Let's look at an example of that. If you're a married taxpayer with $1 million of adjusted gross income, and let's assume your itemized deductions include the following: $50,000 of state and local income tax, $10,000 of real estate tax, $30,000 of mortgage interest, and $40,000 of charitable contributions. So in total, you have $130,000 of itemized deductions. Your itemized deductions will be reduced in 2013 by $21,000, which is 3% of the amount your $1 million of AGI exceeds the threshold of $300,000. So now, instead of $130,000 of itemized deductions, you only get $109,000 of itemized deductions. Now, no matter what your AGI is, those deductions will not be reduced by more than $104,000. So 80% of total itemized is the max. You're always going to get $26,000 of your itemized deductions in this example. But if you think about it, at the 39.6% marginal rate, losing those $21,000 of itemized deductions cost a little over $8,300 in additional federal income tax to you in 2013. Personal exemptions will be phased out as your income reaches amounts over those thresholds of $250,000 single or $300,000 married. The phase-out works such that 2% of your personal and dependency exemptions are lost for each $2,500 of income over the threshold amount. What this means is that married taxpayers with over $422,500 of adjusted gross income will have no personal or dependency exemptions in 2013. Single taxpayers with greater than $372,500 of AGI will receive no personal or dependency exemption deductions. Now, the exemption amounts for 2013 are $3,900 for each exemption. So let's say you're married with 4 kids. You would have $23,400 of personal exemptions. Again, losing all of those at a 39.6% effective rate costs you about $9,000. So in that example, just losing personal exemptions and itemized deductions could add another $17,000 to your tax bill. So what are some takeaways that high-income taxpayers should be thinking about? Well, first of all, many of you, depending on the state you live in, may be looking now at a 50% plus marginal income tax rate. You've got federal income taxes at 39.6%, plus a 3.8% tax on much of your income. State taxes, perhaps local taxes, all combined can get you to above 50% in income taxes. Total taxes on long-term capital gains and dividends can now reach anywhere from 23 to 33%. Again, if you're in that top tax bracket, your tax rate on capital gains and dividends is 20%. In addition, you're going to have a 3.8% surtax on that income. So 23.8% federal, and most states tax that income just as part of their normal, subject to their normal income tax rates. So if you're in a state that's got a 10% income tax, you're paying above 33% on that income. The good news is the $5 million lifetime gift and estate exemption is now permanent. But again, what we would tell you is tax planning really has not been as important as it is now in the past 30 years. So what are some things that you should be thinking about as you approach, mid-2013 and you're thinking about next year's taxes. First of all, certainly look at ideal corporate structures. Pass-through entities have maybe lost a little bit of their benefit. A lot of clients are looking at converting their pass-through entities to a C corporation, particularly if they're not a personal service corporation and not subject to the flat tax rate, can take advantage of graduated tax brackets. You need to be thinking about best practices with qualified retirement plans and fringe benefit plans. Deferring income into qualified retirement plans is much more beneficial in higher tax rate environments. But you want to make sure that your plan or any fringe benefit plan you use is tax efficient and cost efficient. Using small captive insurance company arrangements can provide some tax benefits and is also, more importantly, as a business strategy, a way to reduce your risk and cover areas where you're not currently covered by insurance or where you have high deductibles. Certainly it's more important than ever to have tax diversification of your investments and to be thinking about tax-favored investments. Make sure you're using an investment professional who keeps the tax impact of the investments in mind when helping you make your investment decisions. You know, think about things like oil and gas partnerships, conservation easements, municipal bonds, deferred annuities, life insurance. All these have tax benefits. In addition, charitable planning is key. So making charitable contributions and putting money away for charity, getting that deduction in these higher tax rate environments is certainly beneficial and important. How can we at OJM help you with your tax planning and your financial planning? We do comprehensive financial planning. We want to help you meet your goals for retirement, for your children's education. We do investment management. Our investment team manages with an eye towards tax efficiency and growth of your investments and increasing your wealth. Retirement planning and education and college planning are keys to our process, as well as our tax advisory services and asset protection planning. We look at the whole picture. We use a team of multidisciplinary specialists to look at all aspects of your financial well-being and help make sure that you're asset protected, tax protected, and getting to your goals of financial needs. Insurance planning and legal planning are also provided. And again, what we do is work with your local advisors, your CPAs, your attorneys, to make sure that you're on the right track for meeting your goals. Next steps for you will be, please contact us to request a free copy of one of our books, as you can see on the screen. Or you can download our highlights edition of For Doctors Only. We'd love to do a complimentary consultation with you, and you can subscribe to our newsletter. Our contact information is on the screen. That's 877-656-4362 is our toll-free number, or you can email us at odell@ojmgroup.com. So we'll leave that up for a minute. Again, thank you so much for your time, and we look forward to hearing from you so that we at OJM Group can help you meet your financial goals.